Information in this video is derived from verified public sources. Full references and source links are provided in the description for review. On January 21st, 2026, inside a private meeting room at the World Economic Forum in Davos, Switzerland, something happened that barely made headlines, but would soon send shockwaves through global financial markets. President Donald Trump sat down with NATO Secretary General Mark Rutte. The meeting lasted less than an hour. No cameras inside, no transcripts released. When they emerged, both men smiled. Trump described it as a framework for a future deal involving Greenland. To the public, it sounded diplomatic, routine, even boring. But behind closed doors, Europe heard something very different. Within hours, emergency meetings were called in Brussels. EU trade officials and members of the European Parliament were briefed on Trump's renewed tariff threats tied directly to Greenland. This wasn't just about territory. This was about leverage. Trump had reportedly warned that unless European nations cooperated on Greenland negotiations, the United States would impose sweeping tariffs on key European exports: automobiles, industrial goods, and strategic materials. For Europe, this crossed a red line. What followed was not a press conference, not a tweet, not a dramatic announcement. It was something far more serious. The European Parliament moved to suspend progress on major trade agreements with the United States, effectively freezing the political pathway for hundreds of billions of dollars in transatlantic commerce. To markets, this sent a clear signal. The world's two largest economic blocs were moving from partnership to confrontation, and investors were watching. Because when geopolitics turns into tariffs, tariffs turn into inflation. Inflation turns into higher rates, and higher rates break bond markets. The fuse had been lit. While politicians argued in Brussels and Davos, financial markets reacted instantly. Within hours of the tariff headlines, global investors began repositioning. Not slowly, not cautiously. Aggressively, U.S. Treasuries, long considered the safest asset on Earth, began to sell off. Bond yields moved higher. The dollar weakened. This is the pattern every bond trader recognizes. When foreign confidence drops, bond prices fall, yields rise, and government borrowing becomes more expensive. At the same time, something else happened. Money rushed into gold. Then, silver. Gold surged to record highs above $4,700 per ounce. Silver spiked above $94. An all-time high. This wasn't retail speculation. This was institutional flight to safety. Because in every modern financial crisis, from 2008 to COVID to the inflation shock, the sequence is the same. First, geopolitics, then currency pressure, then bond market stress, then precious metals explode. This time, the trigger wasn't a bank failure. It wasn't a recession headline. It was a geopolitical trade weapon, and investors understood exactly what it meant. If tariffs escalate, global trade slows, corporate profits fall, debt servicing costs rise, and highly leveraged governments face a bond market revolt. For the first time in years, the Sell America trade quietly returned, not in headlines, not on cable news, but in bond desks, commodity desks, and sovereign wealth portfolios. The bond market was blinking, gold and silver were screaming, and the global financial system was being repriced in real time. While headlines focused on tariffs and Greenland, something quieter, and far more dangerous, was happening inside global capital markets. Foreign investors weren't panicking. They weren't dumping treasuries on live television. They were doing something smarter. They were quietly stepping back. At Davos, executives from some of the world's largest asset managers began using a new phrase: quiet quitting the U.S. bond market. The meaning was simple. Not a sudden crash, not a dramatic sell-off, just a slow refusal to buy more. When foreign demand slows, the U.S. government must offer higher yields to attract buyers. Higher yields mean higher borrowing costs. Higher borrowing costs mean higher deficits, and that is how bond markets spiral. Without a single dramatic headline, executives warned that Trump's Greenland-linked tariff threats were creating political risk that bond markets can't price easily. Because tariffs don't just hit trade, they hit inflation expectations, they hit currency confidence, they hit long-term debt sustainability. For the first time in years, senior money managers openly discussed whether U.S. Treasuries still deserved their risk-free reputation. This wasn't ideological. It was mathematical. The U.S. must refinance trillions of dollars of debt every year. If even a small percentage of foreign buyers step away, yields must rise to compensate. And rising yields are how bond vigilantes enforce discipline, not with protests, not with speeches, with numbers. At the same time, foreign institutions were stepping back. One player stood out: China. Official U.S. Treasury data shows China's holdings of U.S. Treasuries have fallen to a 17-year low, from a peak of over $1.3 trillion to under $700 billion. This is not a one-month event. This is a decade-long strategic shift. Beijing has been steadily reducing exposure to U.S. debt while simultaneously increasing gold reserves. Month after month, year after year, central bank data confirms China has been adding gold for more than a year straight, one of the longest accumulation streaks in modern history. To bond markets, this is a warning signal. When a major creditor reduces exposure to your debt and increases hard asset reserves, it signals declining long-term confidence, not in growth, not in stocks, in sovereign credit. This doesn't mean China can crash the U.S. bond market alone, but it means one of the largest structural buyers is no longer supporting prices the way it once did, and when a pillar quietly weakens, stress accumulates. The result? Higher long-term yields, greater volatility, and rising pressure on governments that rely on cheap debt to function. At the same time, China reduces treasuries. It increases gold. That is not coincidence. That is a strategic hedge against a dollar-centric system under geopolitical strain. Bond markets understand that message. So do gold markets. And silver historically follows with leverage. Most people believe bond crashes require massive selling. They don't. In reality, bond markets are built on marginal buyers. What matters is not who sells. What matters is who stops buying. The U.S. Treasury must auction trillions of dollars in new debt every year. These auctions depend on steady demand from foreign central banks, pension funds, insurance companies, sovereign wealth funds. If even a small portion of those buyers hesitate, yields must rise to attract new money. That is how a liquidity problem becomes a pricing problem. And pricing problems become debt problems. This is why bond market stress often appears suddenly. Not because trillions are dumped, but because bids quietly disappear. That is exactly what tariff-driven geopolitical risk does. It doesn't cause instant panic. It causes long-term hesitation. Investors begin to demand higher yields, shorter maturities, more inflation protection. All of that raises the government's cost of borrowing. And in a system carrying over $34 trillion in federal debt, even small increases in average yields translate into hundreds of billions in additional interest costs. This is the bond market's version of gravity: slow, relentless, mathematical. And once it starts, it is extremely difficult to reverse without central bank intervention. That is why traders say, the bond market enforces discipline long before politicians do. Gold moves first. Silver follows. With leverage, gold is a central bank asset. Silver is an industrial and monetary hybrid. When institutions rush into gold, silver initially lags. But once inflation hedging and monetary fear spread, silver often accelerates faster. This happened. After the 2008 financial crisis, during the COVID monetary shock, during the 1970s inflation cycle. In each case, silver outperformed gold in percentage terms once the move matured. The reason is structural. Silver has a much smaller market, lower liquidity, and heavier industrial demand. That combination creates violent upside moves when investment demand appears. At the same time, supply growth in silver has struggled to keep pace with demand from solar panels, electronics, electric vehicles, defense, and advanced manufacturing. When geopolitical stress collides with industrial demand, silver becomes a pressure valve. Gold absorbs fear, silver expresses it. That is why traders call silver the high beta version of monetary panic. And that is exactly what recent price action suggests. Gold sets the tone. Silver amplifies the message. In late cycle environments, silver does not move slowly. It moves vertically. While headlines focused on Greenland and Europe, something far more dangerous started moving quietly in the background. The global bond market. Because when trade wars escalate, investors don't wait for politicians to figure it out. They run. Within hours of the EU freezing trade talks, yields on long-term government bonds began to behave strangely. Not collapsing, not exploding, but disconnecting from normal economic logic. This is critical. In past trade wars, especially during the 2018 to 2019 US-China conflict, the same pattern appeared. Tariffs triggered uncertainty. Uncertainty triggered capital flight. Capital flight triggered massive distortions in bond pricing. And distortions in bonds don't stay in bonds. They leak into mortgages, auto loans, corporate debt, government refinancing, pension funds, insurance companies, even money market funds. In other words, what looks like a political dispute becomes a financial chain reaction. Because the bond market isn't emotional, it doesn't care about speeches. It only reacts to risk. And right now, tariffs tied to strategic resources like Greenland, rare earths, Arctic shipping routes, and military positioning are being treated as systemic risk. That's why institutional investors are quietly repositioning, not selling everything, but rotating. Out of long-duration government debt, out of vulnerable European exposure, out of politically exposed assets, and into one place that always attracts capital when trust in policy collapses. Hard assets. Gold and silver don't wait for recessions. They front-run them. In every modern financial shock, 2008, COVID, the 2018 trade war, precious metals started moving before the headlines admitted there was a problem. Because metals respond to one thing above all: loss of confidence in political and monetary coordination. And right now, coordination is breaking down. The US is escalating tariffs. Europe is freezing trade frameworks. China is accelerating currency alternatives. Central banks are stuck between inflation and debt sustainability. That combination is toxic for fiat credibility, which is why gold doesn't just rise. It reprices, not slowly, violently. Silver historically follows with leverage. It's smaller, thinner, more volatile. That's why during financial stress, silver often outperforms gold on a percentage basis, because it's both a monetary metal and an industrial metal, and trade wars disrupt both. Industrial demand, currency trust, supply chains. At the same time, this is why seasoned investors don't ask, "Is there a crisis?" They ask, "Where is capital moving before the crisis is admitted?" And right now, the answer is becoming clearer. This isn't really about Greenland, it's about leverage. Greenland represents military positioning, Arctic shipping control, rare earth access, energy routes, satellite infrastructure. Trade frameworks are just the visible surface. Underneath, this is a restructuring of economic power blocks. The US is signaling dominance. Europe is signaling resistance. China is watching for opportunity. Russia is watching for instability. And global investors are watching for exits. Because history is clear. When geopolitics and debt collide, currencies weaken. When currencies weaken, metals strengthen. When metals strengthen, the system is signaling stress. So when you see bond markets acting strangely, when you see trade frameworks freezing, when you see precious metals accelerating, it's not coincidence. It's coordination failure. This is how financial resets begin. Not with crashes, but with silent shifts. And by the time the headlines admit it, capital has already moved.